So just a quick disclaimer before we get started here. Nothing stated in this podcast should be construed as legal or financial advice. Both Andrew and Jackie, while founding partners at Nelson Kuiper PLLC, are speaking in their individual capacities as operators in this space, and the opinions expressed in this podcast are their own and should not be construed as a solicitation or advertisement for legal or financial services.
To me, I'm curious whether this is going to bring new parties into the space, new service providers, new vendors.
Well, the big thing that you have to understand is that there are actually commissioners at the SEC who have voiced concerns about these rules.
Hey everybody, and welcome to another episode of The People of Private Capital with me, Ferdy Roberts. I'm the CEO and founder of Asset Class. This week, I'm delighted to welcome two founding members of Nelson Kuiper, a law firm specializing in advising companies in the alternatives and private capital space. Jackie Kuiper is a founding partner of Nelson Kuiper, where she provides modern legal, regulatory, and compliance consulting to corporate clients on matters related to securities, transactions, and the broader private capital markets. Jackie has a JD and an executive MBA from Pepperdine. She served as General Counsel, Chief Compliance Officer, and Executive Vice President of a family office turned private equity and investment firm, and has formed an SEC-registered RIA, an ERA, and a venture capital ERA. So quite busy there. Jackie joins us with her partner in the practice, Andrew Nelson. Andrew is a New York licensed attorney and founding partner of the firm. He also holds a JD and an MBA in finance from the University of Florida. He currently holds a Series 7 license and has previously passed the Series 65 exam, very pertinent for what we're talking about today. Andrew initially worked on behalf of investors in the third-party due diligence capacity, and more recent endeavors include a solo practice focused on fund formation, working on behalf of startups in fintech, insurtech, and edtech. And today we're going to be focusing on the half a dozen or so rules that came out recently from the SEC, focused on the private fund advisor rules. We'll be delving into each of them in quite some detail. We'll be discussing some of the potential ramifications for anybody in the private capital sector, and looking at the long-term implications of this increased regulatory oversight from the SEC and I guess the broader regulatory space. So with that, let's jump into the podcast and welcome Jackie and Andrew. Well, thanks very much, Andrew and Jackie, for joining us. We're delighted to have you on the podcast. As I mentioned in the introduction there, two very, very well-qualified individuals to opine on the topic that we're going to be covering today. Just for our listeners, many of you will be aware, in fact, you got to have been under a rock if you're in the private capital space and not aware of the recent changes from the US, from the SEC, around really focusing on the private fund advisor rules, and half a dozen or so rules that came out as a result of that. There's a lot of conversation about it online, some pretty agitated industry groups that have come out against the rules, suggesting the SEC is kind of overstepping its remit. And we'll delve into some of that over the course of the conversation here today, but delighted to have you both on the podcast.
Happy to be here.
Thanks for having us.
Great. Well, we're gonna just start at a very high level here. As I mentioned, the focus of these rule changes are really on the private fund advisors, and as we say, about half a dozen or so really important rules that these fund advisors are now subject to. And just wanted, before we delve into the detail, to get your high level reaction to them. Good, bad, challenging for companies to step up to meet these kind of requirements. What are your thoughts? Start with you, Jackie.
Thanks, Ferdy. Yeah, personally, it's interesting because I can see both sides of the arguments, right? In a lot of ways, the new rules are going to benefit investors. There's more, again, the SEC targeted increased transparency and clarity in the rules, increased information for investors. So I see the side of that coin as being really positive. On the flip side, I understand why there's some pushback against them. A lot of groups are saying these rules are onerous. They're going to be costly. They're going to actually disincentivize investment, maybe slow investment down. So I think there are good arguments to be made on both sides. And so from my standpoint right now, it's just interesting to read the new rules, see how they're going to be implemented, applied, and to see what kind of continued pushback and then the response to the pushback, what that's going to be.
Yeah. Yeah, definitely a lot of chatter in the trade press, the trade websites that I've been looking at. I know, Andrew, you've been keeping very close to this. Before we kind of delve into, let's say, the most controversial element of this, these new rules focusing on preferential treatment. Before we kind of dive into that, what are your thoughts, kind of initial thoughts, having seen these new rules?
So, while I'm not, and thanks for having us. While I'm not exactly in love with the SEC's rulemaking, I think I was frankly just overall relieved at some of the rules that didn't make it through. And so I think they do feel onerous, but I think I have a couple of concerns with them that lie largely in what comes next. And I think we're in a bad state when I'm actually feeling like these aren't so bad as far as rulemaking goes. But it's because they could have been just that much worse. So seeing the proposals that didn't get through is really where I actually kind of feel more relief than actually sort of frustration at the rulemaking process.
Yeah. Well, one of the areas that Chair Gensler was getting the largest amount of heat from industry bodies was focused on this rule around preferential treatment. And again, just for our listeners, can we break that down? Specifically, what does this mean when it comes to preferential treatment? We're all familiar in the private capital space that money talks, right? So it's not unusual for institutional investors to have side letters or preferential terms around things like management fees or even the carry, where they sit on the capital stack, etc. What are the primary implications of this preferential treatment rule for private capital funds?
I think on its face, the primary implication is that whereas in the past, investors could be incentivized, say your first money in, often you may be given a discount, or a lot of these funds are illiquid, so there may be some preferential treatment in getting out or exchanging your interest or transferring your interest. Those, the prohibition's now saying you can't do that. And to the extent that you're offering anyone, a side letter, something like that, you've got to disclose it. I have no problem with that, and I don't think the industry in general will have a problem with that. But what it does do is it reduces economic incentives for investors to come participate. The disclosure side of it, to me, not a problem. The implication on how it actually plays out to incentivize private investment, that's where I think we'll see the biggest ramifications.
Yeah. Is there, again, just to clarify on that point, so the disclosure is one thing, right, for the fund, if they're coming to agreement with, let's say, a large investor, disclosing the fact that, let's say, management fees are slightly reduced. Instead of 2, it's 1.5 or 1.25. Beyond the disclosure, are they required to do anything else? Are they required to make that available to other LPs in the fund, or?
I believe that there's information rights now where everyone does have to be notified. The disclosure needs to go to everyone. And that's not so much a new rule. In the past, they say if you give information to some investors, you do have to give information to all. So that doesn't change. But how and where you make that disclosure is now, it needs to be more prominent. The disclosure has to be made in every instance. And so I think that's what's going to be required for the fund rules going forward.
Yeah. And before we kind of touch on some of the other rules, Andrew, I know you've been following the press quite closely around the industry bodies and the responses that have been unanimously unfavorable towards Chair Gensler and these new rules. What are your thoughts on that? And do you think that they're either ill-founded, ill-informed, or are they just protecting their own rights? What's your view?
So I don't think that they're ill-founded or ill-informed. I think a lot of it may be reactionary, but at the same point, the big thing that you have to understand is that there are actually commissioners at the SEC and who have voiced concerns about these rules. So where I think everybody would have a much easier time with these is if the rulemaking was derivative of some sort of congressional legislation. But the fact is that we just don't have that. And so it's a lot of people are feeling like it's prohibitive on its face, certain aspects, such as the preferential treatment, and that'll hurt the industry. And on top of that, really it's not the SEC's place or Chair Gensler's place to be pushing these rules out in anyhow. So,
yeah.
I think the MFA, the NVCA, and others are right to bring the action. Whether they will prevail or not, that's a different question. But I do think that they made the correct decision.
Yeah. What are your thoughts on? I mean, when I first saw the details, I mean, like yourselves, I had kind of a mixed reaction because transparency, disclosure. When you're talking about the kinds of investments that institutions are making, high net worth individuals are making, right down to the retail investor, disclosure and transparency is a good thing, right? I think most people would agree with that. But at the same time, I think it's realistic for these larger investors to have the opportunity to negotiate on their own behalf based on the investment. If you've got an anchor investors coming into a fund, do you think it's fair that they'll be required to disclose that level of detail? Because yes, by their very nature, they are preferential terms, right? But equally they're putting more money in. What do you think is motivating the SEC's drive to have that level of disclosure? Is it the growth of retail investing? Is it to as part of a kind of a precursor to some rules that are likely to come down the pipe relative to this broader base of investors that need to be protected? What do you think is motivating them to disclose at that level, Jackie?
I don't know that it's about new rules coming down. It certainly could be. But yes, I think growth is one thing that has fueled this. This industry right now is a $20 billion industry, and it's seen considerable growth over the last decade. What's interesting is that one of the hallmark concerns about the SEC is what I would term, regulation by enforcement. And these rules are meant to protect investors. But as to your point, if there is a larger investor bringing a lot of money to the table, bringing a lot of money in early, do they deserve some preferential treatment? And I don't know how to answer that. I would say perhaps. That's my personal opinion. But what's interesting is how this will play out. Because
Andrew, from your perspective, what are your thoughts in terms of what's driving this this action, should we say, on behalf of the SEC?
So this is complete supposition, of course, but it definitely feels like it's politically reactionary. In light of some events in recent years, such as the blow up at FTX, the issues with some of the regional banks and lending, such as Silicon Valley Bank, I feel like there's probably some impetus in DC to push down on what is an opaque landscape to them. However, it's one of these things that I think, Chair Clayton, when he was in charge of the SEC, for example, refused to actually really move on classifying whether or not cryptocurrencies were securities. And, that was just because he didn't feel like it was in his purview. This regime of the SEC definitely feels like they've got an expanded purview compared to the previous one.
Yeah. Well, it'll be interesting to see how it develops. to me, and you made the point in kind of some of your opening comments, what's just as interesting is what didn't, proceed at this point, but it seemed to be on the table. But let's focus on what is happening and the rules that are in place right now. Moving on from the preferential treatment, the restricted activities rule, right? There was the restricted activities rule, just to kind of call it out for people, prohibits advisors to private funds from engaging in a number of specified activities without disclosure. And so some of those areas include investigation expenses, compliance expenses, reducing clawback by taxes, borrowing money or securities, unless certain disclosures are made by the advisor. And so again, just wanted to kind of get your thoughts on that in terms of how easy it's going to be for funds or fund advisors to comply with this, and what kind of overhead that's likely to place on these funds.
I personally just think it's going to require a lot more bookkeeping and more notice, just more communication, enhanced communications, really, which is not necessarily a bad thing, but it can be a little bit of a costly thing, right? You may need to add team members or add, different roles within your organization to make sure that these notices are being tracked, they're all going out, investors are receiving them, and that you're housing all of these properly. And can provide proof to the SEC that you've made these disclosures and requisite notices.
Yeah. I mean, that's clearly, I come at it from a slightly different, I come to the same agreement, but I come at it from a different perspective. As a technology provider to the sector, I see the increased need for auditability, as you say, the books and records being maintained, in an appropriate fashion. So if you do come under the watchful eye of the regulator, that you're able to point to it, satisfy them of your compliance with these rules. But I think for the restricted activities rules, that to me, it does seem that that's what it boils down to. So, for example, in investigating expenses, the ask is that you prohibit the charging of allocating fees or expenses associated with the investigation of an advisor or related person, unless you get in advance written consent of a majority of the interested investors. So that's kind of, to me, that makes sense, right? You're required to disclose it. You're required to provide proof of disclosure, and as you say, have the books and records to support that. And the same is true, it seems to me, at least, around things like compliance expenses. So prohibits the charging of regulatory or compliance fees, again, unless you're providing written notice. And so we'll provide some details in the show notes of a kind of a summary of those for people, and you can go to assetclass.com and you'll see a write-up of this. In fact, a recording of this clearly on our website, but just with links to support the detail on this. But it does seem that it comes down to, yes, you've got to keep, on top of your books and records, you've got to have, I guess, to avoid the overhead of throwing additional bodies at it, you've got to put some systems in place to make sure that, this detail isn't falling through the cracks, that you are meeting those requirements. And it's good for us from a technology perspective, maybe not so good. And actually, I think it plays to, Andrew, you mentioned the MFA kind of coming out strongly against this. One of their observations was that this is penalizing some of these smaller funds and certainly earlier stage fund managers because of the overhead that this was likely to place on them. So, yeah, this administrivia that's being added to it is certainly not helping the case for the SEC. But let's switch to kind of another one of the rules that's causing a little. I'm not sure if it's as controversial, but the quarterly statement rule, which is requiring that all registered advisors provide detailed performance, fee, and expense reporting to their investors on a quarterly basis. Jackie, what are your thoughts on that in terms of let's say the appropriateness of the level of detail that they're looking for on a quarterly basis? Do you think it's appropriate, it's fair on not just the smaller funds, but on the larger funds, given the complexity of what that entails?
Fair is a funny word. Again, I think it's two sides of the coin. It's beneficial for the investors. It's wonderful for the investors. That type of information should be tracked, monitored, accessible, shareable with investors, particularly at the big shops. It is going to be, again, it's going to be a bit onerous, especially for some of the smaller funds that are not used to reporting on a quarterly basis. Again, it's a good thing. It's enhanced communication, but it's more work. And again, I think this goes back to how you back it up. Are you tracking all that data live? How easily can you assemble it and how easily can you share it? It's about keeping good books and records. So again, back to the word fair. Yeah, it's fair. It might be tough to implement, but I do think it's fair.
Yeah. Yeah, definitely seems to be, certainly from an LP perspective, with a couple of exceptions. There's a possible, I won't say unintended consequence, but actually very real consequence for institutional investors in terms of the flexibility they have around the terms that they agree around investment. If the perception might be, well, hey, if that was disclosed publicly to all investors in the fund, maybe I won't be as happy to try and negotiate at that point. That might actually favor the GPs, who knows? But potentially penalizing the larger LPs in the fund. For just to pause for a moment, you guys obviously at Nelson Kuiper, you focus and you provide support to fund managers, whether they're early stage funds that are creating the funds, putting the agreements in place, the structures in place, et cetera, amongst a wide range. And again, we'll link to you guys in the show notes for people who want to check you guys out. It's nelsonkuiper.com. How is this going to change, for example, the services that you provide to your clients? Is this providing a more onerous kind of disclosure in the PPM and supporting documents for LPs to sign up to, or is it too early to kind of say at this point?
It's probably a little too early for our current client roster. I will say the biggest fear that I actually have about these rules aren't as that they are as currently situated, but it's rather that they get adopted by FINRA and start getting applied to basically non-SEC fund advisors and all private funds in general, because we see a lot of these, and while it might make sense for, say, a hedge fund that's considered a boutique fund at $700 million, that's still trying to raise that money, and we can debate whether or not that's onerous. It makes a lot of like that, $100 million or less sort of private placement offering work actually pretty impracticable on a launch standpoint. And it actually creates a hurdle rate for GPs to overcome just in terms of performance. So it actually can hurt net returns to investors too.
Yeah. Well, it'll certainly be interesting to see how that plays out. We have a few more rules to cover here before we kind of break back up to the macro level picture. I guess a byproduct of the books and records is this fourth rule, the audit rule, and so this requires these registered private fund advisors to undergo a financial statement audit annually, and first of all, how onerous is that going to be for funds moving forward, and this examination that they're subject to in far more detail? It's costly, as you mentioned, Jackie. It's time consuming. It's going to require additional resources, which I guess that's all. This all feeds into the cost of capital, which in turn is potentially dilutive to returns on the fund. But what are your thoughts on that, Jackie? In terms of auditing and how onerous this new rule is.
This one to me is pretty onerous for the people that have not been practicing this. I think there are a lot of, especially larger funds, that do this anyway. They're whether their exemption requires them to, or they've chosen to offer audited financials. I think it's a great move, and a lot of groups are already doing it. But for those smaller funds this is going to be costly, and I think ultimately potentially adversely impact investors, just simply due to the cost.
Yeah. What about yourself, Andrew? Any thoughts to add to that?
Yeah, I actually think that I agree with Jackie completely, but I think it creates a higher barrier to entry on new funds to launch, just in complying with this right off the bat. And, I think the thing that we have to remember is that a lot of limited partners in hedge funds, private equity funds, venture capital funds, they're all highly sophisticated and they have strong economic leverage in general. So, while it might be best practices for a fund to actually provide this anyhow, we're not exactly having LPs who have no understanding of the economic risks and no wherewithal to sort of be able to do their own investigative due diligence before allocating capital.
Yeah. Well, we'll watch it with interest. We know it's subject certainly to negative feedback. I think the assumption has got to be right now, if you're a private capital fund, these are in force. You're required to comply with them unless any of the actions that are taken are successful. But do you have and I appreciate this is just an opinion. It's not legal. Let's say your legal opinion, but do you have any sense of whether or not that's likely to get anywhere other than people expressing their displeasure at the fact that they now have a bigger weight to bear as a fund? Do you think any of these industry bodies are likely to get anywhere with their actions?
I actually do, and I think what we have is the Fifth Circuit's going to hear this. I think it likely goes up on appeal to the Supreme Court. I think, given the makeup of the court as it currently stands, it would likely be seen as overreach. And especially in light of, say, Hester Pierce's statements where she thinks it's overreach. She works inside the SEC and her word carries a lot of weight. And so when she's actively voicing concerns about these new rules herself, I think it's going to look pretty tough to the SEC to defend all of this to the court. Some of this might get through, but I do think there will be the industry orgs prevailing on a number of points.
Yeah. Well, time will tell on that, but definitely enough weight going behind the pushback. So that will be interesting to see. So there were a couple of other rules here, effectively focused on the fifth, which is the advisor-led secondaries rule, which again is following that theme around disclosure. Disclosing, for example, if you have a financial interest in the fund and things of that nature. We can provide some details of that on the website. It's, to me, unless you guys have anything you'd like to opine on that, it seems perfectly reasonable that those kinds of disclosures would be made. Any thoughts on that, or you think, well, it seemed to me that it's not an afterthought by any means, but there's certainly a lot of activity in secondaries, and this seemed to me just like a little tightening of, hey, just make sure that this information is now made available to people, and all of the investors in these private funds getting a written summary of that, anything that's material to that secondary. Is there anything that's noteworthy in that rule, or is it just exactly what it says on the can?
To me, I'm curious whether this is going to bring new parties into the space, new service providers, new vendors, because one of the things that's required is that the RIA obtain a fairness opinion or valuation opinion. If we're doing a valuation report, who's providing that? What is it costing? Does that bring new groups into the industry?
Right.
We'll see. But that to me was a curious point about that rule.
Yeah. That's essentially that fairness opinion needs to be produced by a third party, So it's kind of a hands-off view of the fairness of the transaction. That's basically what that entails, Jackie?
Yes.
Yeah. Okay. Yeah. Well, that's the advisor-led secondaries rule. Again, we'll provide some details on the website about that. There are some specifics there, and then the final point is really focusing on the dates. And yeah, it struck me there's not a huge variation between those that are less than $1.5 billion and those who are greater than $1.5 billion. There's a few concessions there. So, for example, the restricted activities rule, the preferential treatment rule, the advisor-led rule, all three of those, instead of being 12 months, if you're more than $1.5 billion, so I guess it's saying if you're running a large fund and there's large exposure there, you've got 12 months to get yourself in line with these with these new rules. If you're less than $1.5 billion, instead of being 12, it's been extended to 18. Am I correct? Am I reading of that, or what are the specific implications of those timelines? Is it that you've got to be compliant by that date? Obviously, any new funds coming in, I'm assuming you've got to be compliant from day one, right? But is there? Am I reading that correctly?
You are, yeah, and it is like a 6-month difference based on your size, and it's you have that much time. 18 months for larger advisors, 12 months for 18 months for both on the quarterly statements, 12 months on like restricted activities if you're larger. You've got that much time to be in compliance with everything going forward and making sure that your books and records are reflecting the new rules. That's a big thing. If SEC knocks on your door and comes in for an exam, they want to see that you've incorporated the rules, implemented them, and have those books and records in place.
Right. Yeah, and they're the rules. I mean, one of the things that when I first saw them, I thought, what is the implication in terms of grandfathering these in with existing funds? What's the overhead going to be? It sounds like they've been reasonable with that, as in it's really funds moving forward. Is that correct, or what are the implications for existing funds that have been launched? Those side letters are already in place. They're getting a pass for this. Is that correct?
Yeah, that's correct. But I think just one thing to think of is that we're effectively talking about a August 1, 2024 date for the larger funds, and then I believe that would be February 1, 2025 for the smaller ones.
Right.
And I think one thing that we should keep in mind is that this could follow a similar path to the Department of Labor fiduciary rule in 2016, where we saw this proposed under the Obama administration. And then once Trump and the Republicans took control, that actually then got diminished down and eventually became sort of the Reg BI. So with the election coming up next year, while we still have to act as if all of these are going to be put in place, and there's obviously legal challenges, I also wouldn't be surprised if there's a change in the political landscape in America to see some of these either wheeled back or given longer on-ramps.
Yeah. Well, I guess we're it's interesting the point you made at the beginning, Andrew, that the landscape that we're in from a broader financial perspective, that the continuous hits that financial services took around SVB and the crypto scandals that have emerged and been less on the financial pages, more on the front pages for the world to see, has meant that there has been this clampdown, and but obviously we're moving in now into election season, and we're pretty much getting into it, getting into the let's say that the political points that each of the candidates are bringing to the table. I'm sure finance will come into view given what's happened over the course of the last year. So it'll be interesting to see what their perspectives are, and obviously which side of the aisle gets into office will depend on whether these become more rigorous or potentially more lenient. So we'll watch that one with interest as well. Well, look, I mean, I think we've done we've done the rules reasonable justice here in terms of the implications. I think and you can keep me honest here, but to summarize, there's clearly a lot more transparency required. Companies are going to be required to keep their books and records in order, far more than perhaps they are today. The enforcement of that is now kind of enshrined in these rules. The restricted activities rules, that seems to drive not just the maintaining of these books and records, but the communication of the financial implications of all of these activities, whether it's charges, regulatory charges, compliance charges, borrowing money within the fund, the use of fund money to cover things like investigation expenses, etc. Yes, you've got to maintain those, but you've also got to be a lot more communicative with your LPs as a result. So that's a large-scale change for many companies who may be used to, at best, sending out a quarterly statement or a quarterly update from the fund manager, maybe even just yearly, to now having that, that SEC remit or requirement, should I say, to do that. So that's going to be an interesting overhead for a lot of companies, as you say, Andrew. Some of these smaller funds, perhaps, struggling a little bit with that. So, any final thoughts? Perhaps just coming back to the opening comment, Andrew, that you made about what didn't get through. Is this a perhaps an indication of what's likely to come? When you look at, let's say, the regulatory landscape writ large, in private capital writ large, is it inevitable that as more, particularly the retail side of the investor spectrum, becomes more involved, that they will inevitably require more transparency, require more regulation, because you're dealing with slightly less experienced investors, but there's clearly demand there, right? The performance of private capital compared to the S&P over the last 10, 20 years is undeniable. Like, they're moving in very different directions. So there's a natural pull towards private capital. There's a ton of money. We've got this huge transfer of wealth that's happening, from the boomers to the millennials, and private capital is it is a hot space, right? It's a multi-trillion-dollar industry, as Jackie mentioned earlier. Do you think it's inevitable that we're just going to see more and more regulation here? What are your thoughts on that?
Honestly, I think it's inevitable that more regulation is going to be attempted. I think what will end up happening is there will be some pushback and some ground that will be given as the years go. But honestly, this is a space that, if you asked a RA 20 years ago about, they probably barely had an inkling. And now everybody at every conference is sort of talking about what their allocation percentages are and how much they should be pushing into real estate or private equity. So I think that will sort of inherently bring more rules forward. I would really like to make sure that the sophisticated, accredited investors and qualified institutional buyers are not burdened by some of these onerous rules that may make more sense for the retail investors under, say, a Reg A Plus offering. So, that's my big concern.
Yeah. And Jackie, you got a tremendous amount of experience in the sector. What are your thoughts, just from an ongoing regulatory perspective? Do you think that's it's likely to become just more and more onerous, and that companies are just going to have to live with it? This is part of the cost of doing business, or?
I think potentially, Ferdy, one thing we have to think about is, what do we value in private markets? Because I think the result of these rules is it moves it closer and closer to public markets, just the requirements, right? And the heavy regulation. So do we value transparency and regulation? Yes. But we also value opportunity and off Wall Street opportunity, which is a lot of these private funds. It's alternative sources of capital. It's other opportunities that you're not going to find in public markets. And so it's going to be a weighing of what we really value, because private markets absolutely have their place. So again, to your point and Andrew's point about politics swaying this a little bit and swaying kind of what drives the commission, it could keep changing and oscillating over time.
Yeah. Well, it's a fascinating space. I'm hoping for our listeners that we provided a little bit of transparency into what's going on there and clarified, some of these rules fresh off the press as they are. I know you guys are front and center in this industry, and we'll put a link to you guys. But if people want to connect with you, follow you, what's the best way for them to do so?
Honestly, we're available on LinkedIn. We have the website. We're fairly accessible. We are, tech focused and heavy in sort of how we enable our practice of law. So, we do try and keep abreast of current trends, and we try and make ourselves available to people in a multitude of channels. But LinkedIn is always one that we'll be able to get individually, or if you want to email us, we have a contact email on the website, and I'm sure you can link to it. So.
Yeah, will do. We'll put that.
We'll also be on site at the Signals conference coming up in New York in October. So come say hi there.
Yes, we will. Appreciate Jackie you coming along to the event. In fact, Jackie will be sitting on one of our power panels focused on the private capital space, where we're making observations. It's really a state of the nation. And so Jackie will be bringing a legal perspective to that. Really looking forward to that. Yes, we're only a handful of days away at the 3rd of October at One Liberty Plaza in New York. That's going to be a great event. It's a full day event. So if you're in New York or plan to be in New York on the 3rd, do pop in. We've got the power panels. We've got some specialist speakers. In fact, just from a political perspective, the 21st Comptroller of the Currency, Gene Ludwig, will be joining us as a special guest, drawing some comparisons between the credit crunch of the mid-90s and what he's seeing in the markets today. He's also a capital allocator as a general partner at Canopy Ventures. So it's going to be fascinating to get his perspective on it. So you can check that out at assetclass.com/signals-2023. So again, we'll link to that in the show notes. Guys, really appreciate taking time out to do this deep dive on those recent rules. We can't wait to see you at the event. And thanks once again for taking time today.
Thanks a lot, Freddie. Really appreciate it.
Thanks, guys.
Thank you.